Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 62 on May 18th, 2019. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Beyond Meat, Coca-Cola, and Intel, and we discuss three new trades on Carrizo Oil and Gas, Bausch Health Companies, and American Airlines. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to follow along on the show. You can visit our website and click on the videos tab to watch them, or visit our YouTube channel for the Weekly Option. This was a very volatile week in the market. We certainly saw a 600-point down move on Monday, and we had some comeback over the week, but definitely had a significant recovery from the lows, which is great. The Dow Jones Industrial Average finished the week 178 points lower, so it closed at 25,764 points on Friday. The S&P 500 index finished at 2,859 points, or 22 points lower than it was last week. Now, I want to go ahead and get into the topic of the week, and I've had a couple of really interesting events this week. One is that I spoke with an alumni of my business school, the University of Chicago, and he, refuses to even discuss options, which is how a lot of people are. When you mention options, they either see options as this great way to get rich, or they see options as, a tool that the devil uses to take money out of your account, right? It's one or the other, and I'm somewhere in between. And then I'm also actually listening to the audio version. I prefer that sometimes because I end up driving a lot. Listening to the audio for Benjamin Graham's The Intelligent Investor, which is great, and there are some fantastic tips, mindsets, viewpoints, if you will, rules about how you look at investing versus speculation. And certainly, as I listen to that, I reflect on my own portfolio and ask myself what part is speculation and what part is investing. And certainly what I do on the show each week is speculation. I don't see speculation as the S word, which I've referred to it as sometimes when I was trading corporately. Because it can be considered we don't like speculation because of the negative perceptions that it's had in the news, and speculators are made out to be these evil sort of capitalists. But there is a difference between trading and income or just investing for wealth. And what we discuss here leans more towards investing. For trading and producing income. So with those two conversations in mind, or going back through the Intelligent Investor, and then speaking to someone who's actually done very well as a money manager and for some large companies I won't mention, and is now an active angel investor, and to hear someone with such financial acumen essentially say, no way, not going to listen to the show. I've gotten burned by options. It made me want to talk about one thing, and that's how to lose money trading options, right? Which might be counterintuitive for you guys to talk about, when I have a show that talks about how we make money or we make money on options. Why would I have a topic of the week that says how to lose money trading options? But it's important that you understand. So my first method of how to lose money trading options is to buy options because the risk is limited, right? So most people just come into the market and they say, you know what, I really want to do well. I'm going to buy this at the money option, and I think it's going to go up. And if the market goes up, I'm going to get rich. And what they realize is that they bought an at-the-money option and it goes up. And as the stock goes up, they only make a little bit of money, or maybe they stay flat even because of any number of things like volatility coming off. I mean, there are all these other factors, right? So the challenge with just buying options is that you have to be right in the direction of the stock, and you have to be right on your timing. And so you could have a option position that is meant to offset your stock position, and it ends up costing you, a few $1,000s or more, when in reality you were only buying insurance. And as we all know, with insurance, it's good when you don't have to cash in your insurance policy. That means nothing bad happens, right? So you made money in your stock, but you lost it in your options. And so it's like, all right, well, that sucked. Options are just buying options is just a drain on my money. Then the other way to lose money with options is to sell options, because, most options expire worthless. Something like, I forget what the stat is. It's 60% or 80%, something like that, that the CBOE released years ago, talking about how many options expire worthless. So people just say, well, I'm just going to sell options, and that's how I'm going to make a ton of money, except for one thing. You can lose way more money than you receive by selling the option, right? So let's say I sell a 25-cent option and the market moves against me, and suddenly it ends up costing me $3. You're like, well, that didn't make any money. That's not how you make money, trading options. You definitely lose. So what happens in both of these situations is most people don't have a understanding of risk. So if you want to know how to lose money trading options, don't understand risk. If you want to know how to make money in options, you have to understand the risk that come with these options. And that's why I sort of designed this podcast the way I do. I speak very simply about option trading because I want you to understand risk. We can add complexity. We can talk about, vol and have, 3D images of our gamma and all sorts of stuff. But honestly, that doesn't let me know that you truly understand risk. If you can tell me where you make money and where you lose money as the stock price moves, then you'll understand risk enough to know what you need to do to protect your position. So I look at trading not as how I'm going to make money in the market, but how I'm going to manage risk. It's all about managing risk. Successful traders know how to manage their risk. And you'll hear things like let your winners run and cut your losses early. All that is managing risk, right? So successful trading is managing risk. And I prefer the spread strategies that I discuss on the show because they tend to have a higher probability of winning, plus the loss is capped, right? So right from the start, I know what my maximum gain is and I know what my maximum loss is. And it's just another way that's one of the tools, one of the types of trades that I use to manage risk. There are several others that I teach in my course. And so that's it. If you understand how to lose money in option trading, hopefully you can figure out how to make money in option trading. And, listening to this show is a great start. The topic of the week is sponsored by the Option Studio. If you'd like to learn more about how to make money trading options, definitely watch the video that's on the website. And you can find that at www.theoptionstudio.com. Now, let's get into last week's trades. We'll start off with the covered call on Beyond Meat, symbol BYND, Brian Yellow Nancy David. The stock at the time was trading for $66.22, and we looked at buying that stock and selling the June 67.5 call, collecting $5.90, hoping for a 10.84% return in 6 weeks. Well, Beyond Meat stock rose $23.13 per share, closing on Friday at $89.35. I mentioned last week that stock was a recent IPO and it had dropped off a bit, and I really didn't expect it to move like this. The call that we sold is actually up $18. I say $18. I'm using the posted ask price. So if you were to cross the bid-ask spread to close this trade, you would make, or you will have lost, to buy that call option in, you will have lost $18. Now, the bid-ask spread is $3.80 wide. That's pretty wide, and this is a deep in the money option. Anyone who buys this option is essentially buying stock, and by having sold this option, we essentially have shorted stock. So if the stock stays high over the next 5 weeks, we'll ultimately earn our 10.84% return. Now, truthfully, I hate when the stock falls too much on a covered call, because if it falls too quickly and it moves beyond what we collected for that call option, then we lose money. And just the same, I hate when a stock goes up this much so fast, because honestly, I just would have rather owned the stock or just buy the call that we sold. But nonetheless, I'll never sneeze at a 10% return in a week. So if you want to exit this trade early, this is what I would do. I would actually place a limit order to buy that call option somewhere in the middle of that bid-ask spread. So if you pay $22 for the option to close this option, and then you sell stock, you actually keep an extra $190 of profit in your pocket. So your profit at the end of the day would be $7.03 per option, or roughly $703 for the trade. So by closing the trade off early and buying that option back around mid-spread value, you're going to lock in a 10.5% return for the week. It's worth closing the trade early and taking the money off the table, because as we know, if you leave the trade on and it's still on the market, the price can move. It can move further in your direction, or it can move against you as well. So I actually would lock in the money, even though you'll lose a couple percentage points, or not a couple percentage points, you're actually losing basis points of return. Locking in 10.5% return is well worth it. Now, our second trade was the credit spread on Coca-Cola. When we looked at it, Coca-Cola, symbol KO, Kevin Oscar, last week it was trading for $48.19. We looked at selling the June 48.47 put spread, collecting 35 cents, and because it's a $1 spread, that means we have a maximum loss of 65 cents. That's possible on the trade. Now, the Coca-Cola stock ended the week $1.01 higher, finishing at $49.20 per share. The out-of-the-money put spread, which we sold, is even more out of the money now, so the spread is currently pricing at 22 cents. We sold it at 35 cents, so that means that if you were to buy it back today or on Monday, you could actually lock in 13 cents per spread of profit. Now, this trade has 5 more weeks left, so if you believe Coca-Cola will continue moving higher, you can stay in this trade until expiration. If not, you can always close the trade early for a smaller profit. Look, 13 cents still represents a 37% maximum profit for the trade, because your maximum profit on this was only 35 cents to start. So if you had 35 cents and you actually made 13 cents, that's 37% of your maximum profit in 1 week if you decide to close the trade and take the risk off. Taking money off the table is never a bad thing in my mind. You won't get rich unless you learn to let those renters run, but at the same time, you won't go broke taking money off the table, making a profit. So, you can certainly stay in it. I think Coca-Cola will continue to stay where it is or climb a little bit higher in the coming weeks, but this is a long expiration cycle. June expiration has 5 more weeks left, so you'll have to trade according to your own risk level. And then our final trade from last week is the debit spread we looked at on Intel stock, symbol INTC, Isaac Nancy Thomas Charles. At the time, the stock was trading for $46.20, and we bought the June 48.47 put spread, paying 66 cents for the spread, which creates a maximum gain scenario of 34 cents or a possibility of 51.5% return on the trade. Now, Intel stock finished the week down $1.31 per share, closing at $44.89. Our in-the-money put spread, which we bought, is even more in the money now. That means that the stock moved in the direction that makes us money, which is great. Now, as long as prices are less than $47 per share at expiration in 5 weeks, this spread will finish valued at $1. We only paid 66 cents for it, so that leaves us with that 34-cent profit, or the return of 51% on the trade. Now, part of option pricing is time, as I've mentioned, and there's still 5 weeks left in this trade. Because of that, the spread only gained 2 cents in value. So at the moment, you've made $2 ultimately on this spread. Now, it's also, the stock is actually $2.11 in the money. So I would hold on to this spread longer. You'll see the value of the spread increase in value. You'll see it increase more and more each week in the coming weeks. So definitely keep an eye on the stock and have a plan on how you'll protect your profit if this stock starts to rise again. Like if it starts to move up, we don't want this stock to go up. We own a put spread. So if it starts to move up, think about ways that you can protect your profit and protect your trade. The break-even price on the trade is $47.34, and we're quite a ways away from that. So we have a lot of stock price cushion at the moment, but still, it's an open trade, and as time moves on and this put spread is in the money, it's going to start moving closer to $1. And so, I definitely hold it a bit longer and see if you can capture the full value of the spread. Now, that's it for last week's trades. 2 wins and we'll call it a push with the dealer. But because of the stock movement, that will not end up being a push. It's actually a win. It's just that we didn't see it in the trade value, in the spread value yet. It's coming. Now, this week's trades are going to be all in the month of June. Friday was May expiration, so all May trades are either worth their intrinsic value or they are worth 0. So hopefully everything that you sold expired at 0, and anything that you bought is worth its intrinsic value so that you make some money on it. June expiration, of course, is 5 weeks away. So let's look at the trades for this week. We're going to start with the covered call on Carrizo Oil and Gas, symbol CRZO, Charles Robert Z Oscar. The stock finished the week at $12.92, and I'm looking at owning that stock and selling the June 13 call, collecting 85 cents for the call option, and that creates a net possible return of 7.2% in 5 weeks. Now you enter this trade by buying Carrizo stock for $12.92, and then of course selling that call at 85 cents. This trade makes the most money if stock prices finish above $13 per share. Now our second trade is going to be the credit spread we look at each week. This week we're looking at the company Bausch Health Companies, symbol BHC, Brian, Harry, Charles. Stock ended the week at $25.06, and I'm looking at selling the June 25-24 put spread at 34 cents, which creates a maximum possible loss of 66 cents. And I always want to know what my maximum possible loss is, just so that I can size this trade appropriately and decide if it really fits into my portfolio. Now you enter this trade by selling the June 25 put at 99 cents and buying concurrently the June 24 put for 65 cents. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices finish in 5 weeks above $25 per share. And then our final trade on the week is our debit spread on American Airlines. And, I probably make an American Airlines trade every couple months. I'll see something that looks worthwhile. And this time we're looking, symbol on the stock is AAL, Albert Larry. The stock ended the week at $31.72. And I'm looking at buying the 33-32 put spread for 63 cents, which creates a maximum possible gain of 37 cents per spread, or the possibility of a 58.73% return in 5 weeks. Now you enter this trade by buying the June 33 put for $1.95 and selling the June 32 put at $1.32. This is a debit spread because ultimately we are buying the spread, and this trade makes the most money if stock prices finish in 5 weeks below $32 per share. All right, that's it for the week. Hope you're enjoying the show. Thank you so much for listening. Do me a favor, share it with a friend. If you have friends that are trying to learn about option trading, or even people who trade options and you think they'd enjoy having a few more trade ideas each week, share the show with them. I definitely would appreciate it. And I also love hearing from listeners. I get a couple emails a week, sometimes more, but on average about 2 a week. And I love hearing from you, and I actually respond myself. So if you want to hear any of my craziness or even hear what I'm up to during the week from a trade perspective, feel free to reach out. You can always reach me at eric@theweeklyoption.com. That's it. Have a phenomenal week. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.